Welcome to Biocomputational with Max. Today is Monday, July 21st, 2025. Last week was supposed to be a big one for crypto, and there was some success. On Friday, Trump signed the Genius Bill, which stands for Guiding and Establishing National Innovation for the US stablecoin. Here's a little table of the three acts that the House passed this past week, one of which was, again, signed into law because it's been previously cleared for the Senate. So the Genius bill passed the 308 to 122 vote. Clarity Act, which I'll discuss later, passed 294 to 134, receiving 78 Democratic votes, roughly a third of their caucus. The Anti-CDBC Surveillance Act passed 218 to 210, near party line vote. Here's the short summary of it. I'll work backwards through these bills. This is a standalone bill that attempts to prevent the Fed from issuing a retail centralized bank digital currency. It will be an uphill battle to move it through the Senate because there's a strong Democrat opposition there. Now, in the House, among Republicans, there's also opposition. In fact, there were a series of delays due to internal GOP negotiations, and President Trump had to publicly get involved. And this resulted in an internal agreement that anti-CBDC language will be included in the future must-pass defense spending bill, the National Defense Authorization. Another thing that's not really discussed, and I'll come back to the bills, is that the Treasury Department is awaiting the digital assets report, which was mandated by the White House executive order earlier this year, and it's expected to be released soon. This report will be important to Trump's overall goal of making US the crypto capital of the world, and it will also likely push for market structure legislation and also touch on additional issues of regulatory nature. Speaking of regulatory aspects, this is the primary role of the Clarity Act, which will now move to the Senate for consideration. Chair Tim Scott from South Carolina wants to have a markup in September, which is a meeting to consider and debate amendments. And that still has to get past the 60 votes necessary for a filibuster. And agriculture and banking committees will work together in drafting legislation. So we'll be lucky if we get this through early this fall. And as I mentioned, there are many more details that will be left to be worked out to the SEC and the CFTC, the committee that oversees commodities, once the Clarity Act passes, assuming it passes. So let's come back to the Genius Act that Trump signed on Friday. There's a lot of provisions dealing with division of responsibility, but one of the key provisions is Proposition SAB 122, which rescinds Proposition SAB 121, which was issued by the SEC in its previous staff accounting bulletin. SAB 121 did something somewhat logical, but with very awkward execution. It acknowledged risk of holding crypto assets, but it required those holding them to record those assets as both liabilities and assets on their balance sheets. This is because of possibility of breaches and crypto theft, which is presumably higher than it is for other types of assets. There's definitely, I believe, elevated risk, but requiring it to be put on both sides of the equation meant that it couldn't be used on the balance books to offset anything. So holding money in this form of crypto was problematic for financial institutions and banks. So this is now rescinded, and there is a significant resurgent interest in the digital asset industry. This is hopefully going to pave way for innovation in crypto space, but it's certainly resulting in cryptocurrencies being up. For example, Bitcoin is now around 120,000, perhaps 10%. Ethereum is up double that amount, around 20%. So now let me go back to the Genius Act and try to put it into the context, specifically of American currency. Now, looking back to some of the earliest forms of currency in the colonies as they were, we have certain examples such as wampum, which is a type of polished threaded shell, and it was worn as both currency and bling, which perhaps connects it with gold nowadays. Wampum, a few interesting facts about it. It was legal tender in New England from 1637 to 1661. It became legal tender in North Carolina in 1710, relatively briefly. Now, this may seem like a shell game, but it's more sound than the paper currency that came later. Well, technically, contemporaneously with wampum, the US was using Spanish dollars, as well as British promissory notes backed by these noble metal deposits. Now, during the Revolutionary War, Congress created what was called the continental currency, to finance the war. By the end of 1778, the Continentals retained somewhere between 1/5 to 1/7 of their face value. By 1780, they were worth perhaps 1/40 of their face value, so some 2.5%. Congress attempted to reform the currency by removing all bills from circulation and issuing new ones, but without success. By May 1781, Continentals have become so worthless that they ceased to circulate as money. Now, it's notable that Benjamin Franklin noted that depreciation of the currency had, in effect, acted as a tax to pay for the war. And again, history may be repeating itself. But let's look at a few examples from the period. Very interesting historical documents with odd denominations. The first one is 1/3 of a dollar from Philadelphia in 1776. I like mind your business. The second example from 1779 is for 55 Spanish dollars, or an equal sum in gold or silver. So this is a great example of clearly stated collateral. Looking at the periphery here, we have post nubila foibus, which is a Latin proverb for after clouds the sun. Now, these painful experiences of runaway inflation and the collapse of the continental dollar prompted the delegates of the Constitutional Convention to include gold and silver clause into the United States Constitution, so that the individual states could not issue bills of credit or, quote unquote, make anything but gold and silver coin a tender in payment of debts. However, it seemingly didn't prohibit the federal government, as it discovered this power in 1884 in the case of Juliet versus Greenman, where the Supreme Court sided with the feds. Now, by Constitution of the United States, the states are prohibited from coining money, emitting bills of credit, or making anything but gold or silver coin and tender in payment of debts. But no intention can be inferred from this to deny to the Congress either of these powers. In this 8-1 decision, resting largely on previous cases, the court found that, quote, making of notes of a United States illegal tender in payment of private debt was interpreted as, quote, included in the power to borrow money and to provide a national currency. Clearly, we're going beyond the initial purpose. And this is demonstrably false. As the justice who dissented, Justice Field, observed, there's a difference between terms of borrow and coin money. And he challenged them specifically on this interpretation, which will be important later. He explained that the term to borrow money was settled in other instruments such as municipal and corporate bonds and private contracts, and that allowing the government to make their notes legal tender would interfere with third-party contractual obligations, as in fact was the case in a number of these cases before the Supreme Court. And third parties would be compelled by law to accept the notes instead of coin, which is precisely what they did not want to do as early as the late 19th century. Now, the justice argued that the clause authorizing Congress to, quote, provide for the punishment or counterfeiting of securities and current coin of the United States clearly made a distinction between debt and coin. He also cited many quotes by founders against paper money, including the following by James Madison. Quote, the pretext for paper currency, and particularly for making the bills a tender either for public or private debt, was cut off. Or so he thought. Now, finally, Justice Field wrote that for nearly 3/4 of a century after the adoption of the Constitution, and until the legislation during the recent Civil War, once again noted the war, no jurist, no statement of any position in the country ever pretended that a power to impart the quality of legal tender to its notes was vested in the general government. There is no recorded word or even one in favor of possessing the power. All conceded as an axiom of constitutional law that the power did not exist. And yet the majority found this power. Briefly look into a history of this law. The key day was Thursday, August 16th, 1787. This is when the convention devoted a whole day to Article 7 of the draft constitution, dealing with the powers to be given to Congress, starting with the clause giving Congress the power to lay and collect taxes, duties, imposts, and excises. The discussion of the clause to, quote, to borrow money and emit bills on the credit of the United States touched nerves. One delegate moved to strike and emit bills. If the US had good credit, such bills would be unnecessary. If they had not, they would be unjust and useless. Several other delegates supported him, with one finding paper money, quote, as alarming as mark of the beast in the Revelation, and another saying he would, quote, rather reject the whole plan than retain the 3 words and emit bills. Eventually, the move to strike the terms and emit bills passed 9-2, with New Jersey and Maryland in opposition. Now, there is a footnote that claimed that a vote in the affirmative by Virginia was occasioned by acquiescence of Mr. Madison, who became satisfied that striking out the words would not disable the government from the use of public notes, as far as they could be safe and proper, and would only cut off the pretext for a paper currency, and particularly for making the bills a tender, either for public or private debts, end quote. So Madison wanted to go even further and suggested simply prohibiting acts for making bills legal tender. Other delegates found that Congress could find itself in situations where it needed that power and granted the power to print currency for usage only, not to monetize them. So as SCOTUS found in 1884, they might have been well advised of the history of the paper money, including the Continentals, as the dissenting justice observed, which 3/4 of a century later provided a terrible example of collapse, becoming worthless in a few years. Let me go back to even early in history, perhaps the earliest example of the use of paper money, which occurred during the Yuan dynasty from 1271 to 1368. It was established by the Mongol Empire. The Yuan dynasty was the first Chinese dynasty to use paper money as the sole legal tender. This was known as Chao, short for Jiao Chao. It was initially made from the bark of mulberry tree. Also, initially, it was backed by silver and was used contemporaneously with coins such as copper and iron coins. But the paper transitioned from a full silver convertibility to nominal silver convertibility, and eventually to the fiat standard. As you can see on the graph here, there were several waves of essentially currency printing, and one could say that the third wave broke the camel's back, essentially making the currency worthless and roughly coinciding with the dissolution of dynasty. I mentioned fiat currency. This is essentially one that's not backed by physical commodities like gold and silver, so they can depreciate dramatically or inflate dramatically, which are two faces of the same coin. Now, once again, it was military pressure that led to overissuance of money under this fiat standard. It also resulted in high inflation as the dynasty collapsed. Now, this left such a memorable impression on the Chinese that banknotes were not issued in China again until 1890s, when paper yuan appeared. Now, how does this history relate to crypto and the Genius Act, the one that's been signed by the president? First, Genius Act is effectively outsourcing the creation of digital dollars to the banks, not the Federal Reserve itself. It's explicit about that, especially in conjunction with the third bill yet to be passed by the Senate, the Anti-CDBC Act. Now, this is reflecting the intention also of the founding fathers, as I was mentioning, to use sound private notes created by the banks. Second, the new entities that can issue these digital dollars, largely banks, but also non-bank entities, are similar to the Federal Reserve in the sense of being government associated, but technically private organizations that can soak up US dollars in a way that the Federal Reserve picks up US Treasury debt. So this is a useful sponge for the supply. And as President pointed out, he wants the dollar to be strong. One issue here is that the dollars backing the digital currency are not actually private as intended by the founders. Now, this lack of independence effectively spreads systemic risk like a disease through the entire system of this digital currency collateralized with the US dollar. Effectively, this digital dollar is second derivative of real collateral with 2 degrees of separation from this actual store of value. I'm talking about, let's say, precious metals, fiat paper currency, and the digital dollar. Now, it's interesting to acknowledge that there are essentially 2 schools of thought about the primary role of currency. Now, John Law, who was kind of one of the founding fathers of essentially Western currency in certain ways, thought that currency was primarily a medium of exchange and not a store of value. However, if currency does not store value, well, it will have a very limited lifetime, like the Weimar Republic Deutschmark. Or it can be associated with a downfall of empires. And I'll come back to another example, but I already mentioned the Yuan Empire. Now, we can also trace 2 events that reflect similar experiences to the yuan in the US dollar, namely change from a full to nominal convertibility in 1932, and then to outright fiat currency by Nixon in 1971. I said I would mention another example of the effect on an empire, and I want to once again come back to the Roman denarius, which started being essentially pure silver and was debased, and that debasement coincided with the collapse of the western part of the Roman Empire. Now, while it was technically a coin, not paper, the debasement in the end was so extreme that there was only literally a veneer of silver that would efface rapidly from the coins. And so it essentially became a fiat currency and had to be reformed with another denarius. What's interesting to note is the difference between this essentially, let's say, first and second layer above the actual collateral, namely paper dollars and digital dollars. Paper dollars are subject to banking rules, which include fractional reserve, which is essentially around 10%, while digital dollar requires 100% reserve. And I think this signifies a lack of certainty about this layer. And as I was mentioning, this is perhaps the way that they're going to manage it on the books. It's already requiring essentially 100% collateral. So it's a modest concession. Now, Trump jokingly said that the act was named after him.
We worked hard. It's a very important act, the Genius Act. They named it after me.
But I think he was in earnest when he said the industry would do well under his presidency.
But I pledged that we would bring back American liberty and leadership and make the United States the crypto capital of the world, and that's what we've done. And under the Trump administration, this is only going further. You're going to do really well.
Now, Trump also questions the success of the recent BRICS summit in Brazil over the lack of BRICS currency. It's true, they're having trouble coming up with an alternative to the US dollar, which is an extremely well-established network. However, the BRICS did accept Indonesia with over 281 million people and GDP greater than that of France or the UK.
The Genius Act provides banks, businesses, and financial institutions a framework for issuing crypto assets backed one-for-one with real US dollars, treasury bills, and other cash equivalents. It's really strengthening the dollar and giving the dollar great prominence. And, you know, you have this little group called BRICS. It's fading out fast. But BRICS is, they wanted to try and take over the dollar, the dominance of the dollar, and the standard of the dollar. And I said, anybody that's in the BRICS consortium of nations, we're going to tariff you 10%. And they had a meeting the following day, and almost nobody showed up. They said, leave me alone. We didn't want to, they didn't want to be tariffed, did they, Howard? Huh? So it's amazing. No, we're not going to let the dollar slide. If we have a smart president, you're never going to let the dollar slide. If you have a dummy, that could happen. Like the last one, he would, if you ever asked him about the dollar sliding, he would have no idea.
Now, Trump also says that under a smart president, the dollar would not slide. It seems that nobody's explained to him that some of the value of the dollar comes from its user base, similar to Bitcoin, which is backed by the network of users. And now, again, is around 120,000. So we need to recall what is happening in terms of trade around the world. There are many unresolved tariffs, and on top of that, Trump has threatened to apply 100% so-called secondary tariffs to any nations buying Russian oil, specifically China and India. And this is effectively weaponizing the dollar network, making it less likely to be used. Brazil, which is prosecuting or persecuting, depending on your viewpoint, the former president, is potentially going to be slapped with 50% tariffs. Now, it seems that tariffs become just another weaponized form of the dollar, together with the sanctions, the SWIFT, the freezing and seizing of Russian sovereign assets, and that of Venezuela's gold by the United Kingdom, et cetera, et cetera. So these moves are not conducive to global trade or to the dollar retaining its user base. But to come back to crypto, there are two issues, as I mentioned. Tariffs, sanctions, and wars limit the network potential of our cryptocurrency. But the second point is equally important, that without a foundation of products or services, crypto is simply driving up financialization of the economy. Financialization of the economy means high leverage of economic bets. And these over time drain value from the productive economy. One can look at examples such as Greece, and this deserves its own video. Suffice it to say that the country has been so drained of value that the locals can barely afford to live in Athens. The alternative is a cryptocurrency as a casino, and I'm adding a link to a previous short video I made on the subject called Funny Money in the description. What could function as a foundation for cryptocurrency? So I'll briefly touch upon that, but let's remember that even in the early America, there were three types of currency. A specie, as the coins were called, the printed paper money, what became the fiat money. It started as promissory notes, but later became fiat money, not backed or convertible to anything. And finally, there was a trade-based commodity money. The first is anachronistic and has no intrinsic money velocity or yield. The second printed currency is a recipe for debasement of value. Well, the third is really not been used due to limitations of physical commodities. Who wants to be paid in bales of cotton? But I would argue there is an exception, a modern digital exception that has not yet been commoditized, but can be commoditized. I'm talking about medical data, which can be shared privately and securely. In fact, what is actually shared is the essence of the medical data, the insights. Now, I'm just going to show this one graph that provides an estimated value of the digital collateral for various regions of the world. It's based on medical spending, as well as a number of doctors and nurses. And it was calculated based on a 4% nominal yield based off of the amounts that you see here, meaning, for example, that while the US share of this digital collateral is a little bit above a 1.5 trillion, the country would be able to collect over 60 billion annually in reused medical data. This is an exciting new foundation for cryptocurrency that I want to discuss in the future videos. Please like and share.